Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, March 27th, 2025. It's 12:19 p.m. Eastern Time as I'm starting the video, and here's what I want to cover in this order. We'll do the equity markets first. I want to provide some updates on gold, silver, GDX, and then towards the end of the video, wheat, corn, soybeans, the grains, and natural gas. I'll give you, we reverse that one today. All right, so QQQ, this is a 60-minute chart. There's an uptrend line. Now I can take this trend line too, and I'm going to do that now. And I'm going to tweak it a little bit right here. The reason I did that, you can see you have the lows right there. And I had it at the bottom. If you can see really closely, there's that candlestick shadow down below, or tail. The shadow is the skinny part on the top or bottom. When that's down below, they call it the tail. When it's above, it's the wick. So I had it there, but now it comes in and it captures these. Let me zoom in a little bit better and grab it here. And now I'm coming in and grabbing all of these candles here. So I have the body of that same candle, those three bottoms, and now we have that reaction low that happened. That was the support level I gave you yesterday with the second downside target. The number was turned off, but it was at 480. You can see was the bottom, roughly that gap right there. And then, so this was a gap backfill. Now, somebody asked today, we hit that target, or we were close enough when I replied. And I said, I'm still favoring a little more upside. I expected a reaction there. And the comment was, hey, we hit that target on QQQ, the bounce target, Randy, but not NQ. And I'll show you why. I'm still, I'm just going to tell you my thoughts here. It's, intuition, gut feel. It's almost, we hit the 200 yesterday. We got the rejection. And I said that may be it, and it probably is, but I just kind of feel and sniff a little bit. It's almost too easy. It almost seems like a trap. So I'm kind of just remaining flexible in active trading mode right now. And I think we're going to get probably another push up. I'm not married to it. But again, as I told you yesterday, this is, you have these uptrend lines in both NQ and QQQ. You have a nice price support there. That 480 line was there because that's pretty nice price support. There's a big old gap from the 24th. And that's that. Okay, so if I'm sorry if I'm talking a little bit out of breath. I still have some pain from the surgery, and I am off. The last Vicodin was last night. I'm on just regular Tylenol right now, waiting for that to kick in. And so I'm clear-headed, just a little short of breath from the pain. So forgive me if my voice is a little off. All right, so that's it. So let's jump over to the charts of NQ, and I'll show you what I see here. All right, this is the one I gave you this morning, 60-minute chart. Usually you can see up on the top here, hourly candles. And you zoom in tight, and you can see the gap. The gap I'm referring to is this gap right there in NQ. Talked about it yesterday. I said gaps once entered are usually backfilled. It was a perfect backfill or near perfect backfill of the gap. And so far, a relatively muted bounce. And there's that bounce target. And I'm still leaning towards that, not sold by any means. And yes, the uptrend line is different on NQ. Remember, the futures are going to have quite often different trend lines, even different horizontal price support and resistance levels, because these are trading around the clock. So you're seeing reactions, at 3 in the morning, you're not seeing in QQQ charts. I don't turn on the after hours trades. I just have regular session trades. And so, and the bottom line is I watch them both, even if I were to be trading QQQ and let's say one of my IRAs or other accounts where I might not have trade futures often or at all, then I'll still watch the futures. I like to watch them both. So, the question I had is, okay, so you hit that one target in QQQ, but not on NQ. Why is that? Well, in NQ, you can see there's really on this chart, very little, if any, resistance up until that level. So that's kind of what I'm leaning towards at minimum right there. And as I said in that reply, it's kind of playing it by, as we go here, and that's it. So like I said, we could grind around for the rest of the day, rest of this week. We could turn around and dump. Remember, we had, and I cannot overemphasize the importance of the back test and the rejection off the 200-day moving averages yesterday. So we could just dump today, tomorrow. The levels to watch that are probably going to trigger the next, impulsive leg down is when this trend line, and you can see I have nice price support here on the futures at 19,600, And then, of course, those recent lows, we have several reactions there. That's kind of lights out. If that happens, most stops are going to be hit. At that point, you should have a lot of stops being hit. And we'll just see at the time. I always say the charts are dynamic. How does it look? How do the daily charts look? 60-minute charts, everything else. Nothing's changed on where I think we're going in the coming months. I'm just right now playing it day by day, minute by minute. Volatility is still high. There's a lot of money to be made active trading. You know, you swing a 2% drop and swing a 1% pop. And, you know, if you're trading futures, they're leveraged, or whatever you're trading, even if you're not trading leverage. And let me just say this. If you're new to this, I can't give investment advice. I'm not in that capacity or role anymore. I used to be an investment advisor. What I do is I share what I'm doing, what I see, what I've learned, and you know, my thoughts, levels I'm watching. But if I were to give any generic advice, it would be for those new: stay away from leverage. Cut your teeth either paper trading or using non-leverage ETFs. Don't use leverage. A leverage, once you've honed your skills and you're confident of your abilities to make money. And when I say consistently, that's, you're not going to always make money on every trade. There's nobody bats 1,000. But once you've get your groove, then you can introduce leverage into your trading. And I like to use it too. In the futures, I'll be leveraged highly sometimes in things like NQ or whatever I'm trading, and I might have offsetting indirect hedge positions via the VIX, treasury bonds, things that I cover as well. So that also helps minimize losses. And then again, I always say this on futures, they trade around the clock from Sunday evening through Friday evening, and so with just that shutdown. So I'll usually take down my position at the end of the day before they go into the weekend, because that's really the only time you're going to face a really big gap. They shut down every day 1 hour between 5 to 6 p.m. Eastern time to kind of, whatever they do, reset. And so the gaps are going to be minimal then. The big gaps at your risk is if there's a big headline over the weekend. And so that's the only time you really can't avoid a big move down. So the nice thing about futures, I always say this, is they're liquid at 4 in the morning. You can have a stop loss order. I like to use OCO orders. One cancels the other. And that's if you're long, you have a stop, wherever your stop is, let's say down here, and your price target, wherever that is. So that's how the hourly chart looks. And again, I'm not gung ho that we're going to bounce up there. I'm open to the possibility. I'm open to all possibilities right now. And again, I'm going to get to the daily charts. I'll talk about the 200s in a second. Let me just show you one other time frame I'm watching, and it's this 15-minute chart of NQ here. And there's the gap right there. So we had a little, when I look at it here, we spiked through it a little bit. It looked like the 60-minute we hit it, but it was a slight, ever so slightly quick spike through. And we had nice big positive divergence on the 15-minute time frame. And so far we popped up. We tried to take that level out. They sold into it, but I think they'll clear that. And then this is that same level I showed you there. I was targeting on NQ, and that is my preferred target to be hit today. If they carry it up higher, you can see some additional resistance levels, potential targets. One strategy, if you're not sure, but you think there's more upside, instead of booking profits at the first target, just raise your stops or ratchet them, trail a stop. Just know that in a volatile market, you're usually going to get reactions off these well-watched resistance levels. And if you run a very tight stop, they're probably going to take your stop. But every now and then, they'll punch right through it. And that's a way to stay in the game, or in the position, by raising your stops to protect profits and letting the position ride if you do think there's a potential for more upside. So there are your levels, 20,000, 288. If you're new to the site, I always say, the levels that I mark and I refer to as price targets are the actual resistance levels where I believe a reaction is likely upon the initial tag. As such, I always will set, if I plan to close a position there, I'm going to set my sell limit order on a long slightly below the actual resistance level in case the sellers step in early. I'm not going to try to milk out the last 1/10 of 1% and risk a reversal, because quite often other traders see the level I'm seeing and they do what I do and they step in early and sell. So same thing on short trades. You want to cover a little bit below the actual support level that you expect a reversal to happen on. although I don't trade ES or the SPY, the S&P 500 ETF and futures off, I'm just marking up because this is a newer chart I had to start marking up recently. I will watch it, and mainly because a lot of traders trade it. It is the S&P 500, well-watched index, very liquid, very traded index, and so it's very important as well. And this is the level I gave you right here. The other day we rallied up. That was the the multi-month trading range. It's a 6-month chart, 2-hour candles. So we hit that, and that is most likely the end of the run. So again, call it picking up nickels in front of a steamroller type trade. But let me just show you the levels that are likely to open the door to more selling. We have an uptrend line right here. Somebody asked the other day, I replied last night, they might ask when I was in the hospital, if this, on the daily chart of SPY or the S&P 500, if that's a bear flag. I started talking about it about last week or earlier this week as a potential bear flag. But in my opinion, again, this is my opinion, it's gotten a little too long in the tooth relative to the flagpole. An ideal, if you look them up, just Google the pattern, you'll see usually it's something along that line. It's, you don't get, you don't want to see it half or more than the length of the flagpole. The flagpole is the impulsive move down leading up to it. So again, it could be. Now, what you do have, for all intents and purposes, the same thing. You have an uptrend line right there and price support. So there's a level that now we have this third confirming reaction today that will most likely bring in some more selling if broken on ES, the S&P 500 futures. This is, again, a 6-month, 2-hour candlestick chart. You can do that on a 60-minute chart. And we can probably do it on SPY. Let's see what I have marked up on SPY. And again, I track these even if I'm not trading SPY for the reasons I said. A lot of other traders are going to trade it. It is an important index. And so if you see, because what will happen, sometimes you have an uptrend line, say on QQQ, and that uptrend line breaks. So you want, I've learned this, believe me, over the years. What I do on this site is I am sharing, lessons I've learned over decades, very costly lessons. Trading is, I've never paid for any trading programs. Can imagine I'm self-taught, self-learned. But the lessons I've learned, that's what I try to pass along to you. And one of those is, when you're, and why I watch multiple indexes as well as the key stocks, you could see a breakdown in QQQ at the same very time. QQQ is breaking down. SPY, the S&P 500, falls to well-defined support. Buyers step in and they rally it off there. What's going to happen is the breakdown on QQQ will prove to be a false breakdown because QQQ has the same stocks. It's a lot of overlap, especially the top components that make the biggest difference are the same top components of the S&P 500. And so therefore, I want to see both indexes break down. I want to see the majority of the Mag 8 stocks break down. Again, they're the same top components of both indexes. And so there's an uptrend line to watch and some levels right there on SPY. Let's talk about those 200s. Again, sometimes I just go off instinct and, we hit and we had a rejection off the 200s yesterday, the 200 simple. Like I said, right now, kind of good time to maybe not get fully aggressive on the short side. It is certainly, as I maintain, I talk to the long-term trader, swing trend trader, and I talk to the active trader. And active trader mode right now, I'm just gaming those intraday charts like I just started out with. Long-term swing trading, nothing's changed. We shorted the highs on the NASDAQ 100, and we're very profitable. We're below the 200s. They haven't been taken back yet. I put a just decent odds, not super high, that they might want to just try to run this out because I think so many folks are probably talking about and watching the 200s and the market never makes it easy. It would be a beautiful situation to see a stop rate above the 200s on SPY and or QQQ, only to see, and get suck in some new bulls, some longs, suck out some short sellers, and then reverse it down. Again, QQQ is comfortably below right now. So I don't think we're going to see the Qs take back the 200-day. And if they did, I'd be a little bit cautious right there. Again, we're, by all metrics, I've had a lot of check marks. Don't get me wrong. Please don't get me wrong. I still fully maintain and have a pretty good degree of confidence my longer-term swing targets are going to be hit. If you're new to the site, those are here. Been calling for a drop down. This is my final target of calling for about a 50-something% drop in the NASDAQ 100, just over 50% down to the 260 area on QQQ. And it's really, these are targets I laid out last year in 2024. We already hit the first and second targets, bounce, and I consider this just the same macro call, long-term call. We made a marginal new, as I said it would be if we did it, because the divergences were, the indicators were lagging to the point that I said any new high would be a divergent high and likely fail. And that's what happened. So this is, and now looking at that, on QQQ, you could say, again, it's getting long in the tooth, but it's possible this is a bear flag. That one's not as big as SPY. That looks a little bigger on SPY, at least on the daily chart. And like I said, it's almost too easy. And that's what's giving me a little bit of pause. You've got the 200s getting taken out and back tested, just like back here. Remember, we did that same thing. We traded it this way back in 2021. We were short right off the highs at that. We shorted based on the 60-minute chart, that bearish rising wedge break. Got short there. Then we had this shelf of support, just like now. We had the trading range up there. Following the trend line break, we had the trend line break here. Then we took out the 200s and we gained this bounce. We shorted the rally back to the 200. It's simple right there. We reversed there. Again, active trading based on 60-minute charts. Rallied back, shorted the 200s again. And so that's one reason, it's almost too obvious a play. And so, just take that for what it's worth. So I'm just kind of staying flexible now. And again, I don't think we're going to new highs, but if we do, I promise you I'm not going to be short on swing and trend positions all the way up to new highs. So let's just see how the 200s are resolved. I'm open to the fact we can punch through, and I'm very open to the fact that that's it, that we tagged them yesterday, the last couple days, and got rejected, and we may not. So hopefully that makes sense, guys. I'm just keeping it flexible, and I will continue to post my my thoughts as if and as they change. I just wanted to cover this one too. This is my ES 60-minute chart. So there was the bullish falling wedge, nice clean downtrend line breakout, positive divergence. Hence the reason for covering our shorts there, gaming this bounce, which I said went up to about the 38.2% Fibonacci retracements, as well as a back test of the 200 days on both the NASDAQ 100 and S&P 500. We recently put in that on the 60-minute charts, those divergent highs there. And again, you can see the levels right here, my price support levels. And the only thing I need to add here would be that trend line, uptrend line right there. Okay, so that's it right there. Break of that should be net bearish, take us down to there. But right now we're above support. We've had two tests of this support. And this is kind of what I'm leaning towards, another thrust up like that, maybe something like that. I'd figure I'd update IWM and RTY. RTY are the Russell 2000 futures. So the futures contract for what is IWM, the ETF. And that was the, I must have given it to you on a 30 hourly chart. No, I don't know where. It should have that trend line there. Sometimes these charts on this program just kind of the lines go away and I have to replicate or redo the lines. But that was that bullish falling wedge. And these were the targets. This is still very much, I'd love to see this. It's a real nice re-entry. And that was I believe what I gave you is my maximum bounce target on RTY. The Russell 2000 futures. So if we do get a little more upside, that would be an objective level to close out longs a little bit below that downtrend line and that horizontal price resistance level, especially if they come in together, which they probably would right there, and then reload on the short side. Now, we may not get that. I wouldn't bank on that, certainly not. We've taken out the 200s. This market's still pretty heavy. And like I said, it's showing me the traits of a bear market. We've had a couple days of rallying. The stocks that I figured that were beat down the most, Tesla, all that took off. Everybody thought it was safe to come in the water. And yesterday's hammer down when we hit those, preferred bounce target zones, that hard reversal. That's kind of the signature of a bear market. It doesn't let the longs out easy, and it doesn't let the shorts in easy. So. Anywho, so let's just say I'm cautiously near-term bullish for a little more upside and maybe this week, and we'll see there. Okie dokie. Let's go over to, well, I might as well. I know most traders trade ETFs, so let me just do IWM real quick. This is IWM. I gave it to you on the 60-minute chart, I believe. And yeah, same thing. This is we had this bullish falling. Well, that was the breakout. There was a divergent low. We hit my first, second target, went a little higher, and these are still. This is still the maximum bounce target zone. That if we get there, that and then you also have that price resistance level there. So somewhere in here, there to there. That's the max bounce target on IWM. All right, what did I tell you next? Gold. So yeah, let's talk on the metals and miners. Somebody asked, I gave an update on the homepage. 60-minute chart. So on gold, we had the breakdown there. We hit my first, this was, gave it to you on a 60-minute chart. My first support level was at 276.93. We bounced again a second time. We're still there. Nothing has changed technically. The breakdown, the sell signal is intact. We made a marginal new and still divergent high, and we still need to take out this first support level. That's the way it works. And when we do, if we do, anytime soon, we should head down to at least that trend line. A break of that trend line would trigger a more powerful sell signal. The divergence is starting to get a little steeper now, if you will. You can see the slope of the divergence line. And so that's still a divergent high. They're buying gold. I'm going to cover a few more charts for you here. This is what it looks like on the daily chart. That would be that little downtrend line I gave you right there. There's that more significant trend line. Big divergence, but gold's just had a strong bid. You have the central banks buying, a lot of retail traders buying, worried where to put money now. Stock market's going down. Bitcoin, of course, because it's been correlated with the stock market, it's been going down. So gold continues to catch a bid, but let me show you a couple other things. Silver still back testing the this trend line here, this one right there from below. Any equal or marginal new high anytime soon is still going to be a divergent high. Remember, this was a divergent high there, and it played out for, or was followed by a drop of about 17, almost 18% in gold. And if I take this line across, again, anytime soon, if gold makes an equal or marginal new high, it is 100% guaranteed to be a divergent high. So I'm just going to duplicate that line, tell you that. I'm sorry, silver. And that's it. And so probably take us down to this longer term uptrend line, maybe the 200-day moving averages again. And let me jump over to the futures here. Let's do GC. Where's my GC? Okay, GC. I'm going to borrow that. Remember, this was the divergent high. I gave you this one the other day with 3 targets there. We broke that's a sell signal, nice clean wedge break, but we hit my first support level there. Bounced, went down, almost hit that first target, reversed a little shy. And all we've done is made a marginal new, meaning ever so slightly, and still divergent high. And so the outlook of gold still looks the same to me. We'll probably come down to at least that third target. If and when that happens, you can see there's the divergence lines right there. So you can see the divergence hasn't been taken out. It's only grown larger. Could be taken out, but it's not. And therefore, my outlook for gold hasn't changed. In fact, this little thrust up here, more on silver too. Let me show you silver. Silver, this move today, this thrust up to make a marginal new. Remember, we had a divergent high there. We had a trend line break, a sell signal, went down, hit this uptrend line, hit it again, bounced. This very much looks like a near-term buying climax right there. That straight up move looks just like this one here. That's often what you'll see in silver. You get these, you get the initial top, first drop, the buyers come in and then give that almost vertical move there. And probably confirmed if I put on volume, you'd probably see, yeah, big volume spike as well. That's indicative of a near-term buying climax right there as well. So that's it. So if we reverse, which I suspect now, that should be the top. I actually already had some silver and went underwater a little bit and shorted back here, added it to today based on that. And we'll add if that trend line breaks, and we'll add if that trend line breaks, and try to swing it down. I think there would be a nice reversal. And let me show you, well, let me go to silver. SLV, 60-minute chart right there. There was the divergent high. And there's that marginal new and still divergent high on, and it's a back test too. This is the trend line I'd given you on the 60-minute chart. So I just take the divergence line, extend it out, And that's it. Now, I always often say that any analysis in gold or silver, especially gold, silver is going to follow gold. It just tends to go up and down in a multiple of. And the euro US dollar pair is my kind of go-to proxy for charting the dollar. Here, let me do this for you because I know there's some new subscribers to the site recently. I've covered this many times in the past. Gold typically moves inversely to the dollar, meaning in the opposite direction, and it's not a it's very simple. The gold, if you freeze supply and demand, meaning at any point in time, you have a roughly equal number of buyers and sellers, which is a lot of the time, then a falling dollar is going to cause gold to go up more in price because it takes more dollars to buy 1 ounce of gold. Likewise, a rising dollar, again, if there's not any overwhelming supply or demand things going on, it takes fewer dollars, so that will cause gold to go down. Wait, did I say that? Yeah. Falling dollar, gold goes up. Rising dollar, gold goes down. You can see it here. You just go to Edit Chart Properties, Add Gold. And you can see, so what I'm doing, the euro US dollar pair is the dollar upside down. The euro is 57.6% of the dollar index. It is by far the largest component, not even a close second. The next second largest is the yen. It's like 23 point something. And then everything else you can add up, the Swiss franc, the euro, I'm sorry, all the other major currencies, the pound, they don't even move the needle. So I'll use euro as a kind of a proxy for watching the dollar, or you can look at the dollar index. And again, but when you turn the dollar upside down by looking at the euro US dollar pair, then you're looking at a positive correlation. So I'm just showing you that. This is a long-term weekly chart. So you can see they both go up. And the way you want to look at correlations, these lines aren't going to overlap because they're not priced on the same scale. What you want to look for are the turns, the inflection points. So they're both rallied there, peaked. They both went down. They both had a peak there. They both rallied for a little while. And again, it's not. There are times where there's disconnects. And those times are going to be when there's an overwhelming. We had an unusual disconnect recently. A lot of demand, a lot of buying in gold, even though the dollar or the euro was kind of going sideways. And then we had this move down. We peaked right there. And there was a correction in gold. You can see the purple line's gold. It corrected there right when we peaked. Then this last thrust up. This is that final, the recent thrust up. But again, you can see the overall long-term correlation. Look when they peak. Again, that's what you want to look at. And there's a major bottom in both. They both started rallying. There was a peak. That one peaked earlier a little bit. But you can see overall both falling here, right? Both going up here, both reversing. So where I'm going with that, I'm going to turn off the correlations now that I've shown that. And again, there's been a strong bid for gold lately, which has offset the impact of the dollar and the euro. Again, if you just, like I said, free supply and demand, that's the simple reason why the dollar will go up or gold will go up when the dollar falls. On the weekly chart, so let's go back to that, turn on my lines. So you can see I had, for a while, I've had this uptrend line right here that was broken right there. We went down, hit this as major long-term support. That was a big fake down. Yeah, that was written back then before what happened. I figured it would be a bear trap or a false breakdown, which it was. And we rallied back above there in this long-term support zone. You can see this is really throughout history of the euro and US, since the euro started. This is where the support level's been, other than that brief false breakdown there. So we're coming off that level. But we also just got rejected here. So this tells me that if we head down a little more, that should put pressure on gold and silver. Now, if we break out and run up, you can see a long-term downtrend line. That would be a net plus for gold and silver. So I just want to say I keep that. I do look at that. When I go to the daily chart, what I can tell you is we were overbought recently. Again, my definition, and I've talked about this recently. Here's another trading tip. I pass this along. If you followed me for a while, when you open any charting platform and you put the RSI up, relative strength indicator, that's a great measure of how oversold or overbought a security is. The default lines are 30 and 70. That's the red line here, overbought, and 30 is oversold. I take those and I don't throw them out the window, but I look at it and I look at every security. I analyze it separately. And I put my own lines if those aren't the lines. Some securities work very well. They kiss, like the S&P 500, for example, SPY. The 70 and 30 levels work very well. Oversold when you get down to 30 level. In a bull market, you want to step in and buy. When you get 70 overbought, often you'll sell. That's when rallies will stop or close to stopping. But you can see what I've done on the Euro, EUR USD. 77 to me is overbought. 22.5 is oversold. Why? Because I simply look at where it goes up. So it doesn't, sometimes it'll stop when it hits 30. And I leave that line, or 70, and I leave that line up there. But this is more of the extreme overbought. And so we just hit it. Last time we hit it was there. We did go on to make a marginal new high, but barely above that level, and then had a big drop. Time before that was right here. We got overbought. Again, put in a divergent high and a trend change. So it just tells you when you get overbought, sometimes it's one and done, like right there. This could be that one and done, or we may push up, make a marginal new and still divergent high. So keep that in mind in trading gold. So right now, I'm going to treat it like it may be one of these one and done tags there, and we'll see. Either way, we started a correction. The euro's been falling. Gold has not gotten that memo yet. If the euro continues to fall, and that's where you can look at the 60-minute chart. You do have some positive divergence, but you're also coming off this negative divergent, that divergent high there. And let's see if we can put this here. So if this breakout fails, I would say euro probably dropped to this level. And if the euro does drop down to this support level here, that will most likely put some pressure on gold and silver. And maybe that's when gold and silver, or around that time, they'll hit the price targets I gave you. You'll have an uptrend line there, and that might be when I cover those shorts. Okay, I'm going to cover, I was going to cover wheat, corn, and soybean first. Let me cover natural gas. Talk about that. That was just for me, a monster trade. Quite often I'll identify these, major inflection points on big trends. Remember, I trade futures. It was up much more than the UNG. UNG is an ETN that rolls futures contracts, but they have a lot of expenses and fees, so it'll underperform futures. And I was, beating the bullish drums on this since back here, and I stuck with it. We had all these little starts and fits off the 60-minute charts, and we even exited quite a few. We hit a final target zone there, pulled back. So I kept a lot like the VIX, where I've had these hit and run trades for since last year. It took a while, but I stuck with this one from a longer term perspective and maintained that 490 target I started laying out in early 2024. And we hit that to the button. Like that was go down in the record book trades. We're long at the lows. And the last, last entry was right off the lows. And so I'm going to compare this to wheat in a second here. But I also wanted to show you for this trade, for those of you that took it. How did I do it here? There it is. So you can see this uptrend line right here on UNG, price support as well. I already gave you the chart of nat gas futures today, so you can reference that one. And again, I would use the target I gave you on nat gas futures. Even if you don't have a futures account, you're going to trade UNG. You can get free futures charts if you have the Schwab Thinkorswim platform. They'll give you futures, live charts, TradingView. I believe TradingView and Investing.com will all give you free real-time futures charts, so you can at least correlate those price and resistance levels. All right, so that is natural gas, or at least this is the one I gave you today. Nope, I'm trying to grab them. Where'd it go? Natural gas, where are you? 1 second. Okay, there it is. I just had to fit it in. This is the chart I gave you today. So that was our exit point. Again, futures will roll, price levels change. That was the 490. I screenshotted the day we exited that long-term target. And this is a bullish falling wedge pattern, complete with positive divergence there. It was nice to confirm that we had negative divergence when we hit that long-term 490 price target. And so, like I said, we turned around, straight out, that's a case where, take a trade, milk it to the very end, turn around, reverse it, and keep it going on the other direction. And, like any trade, it either pans out or not, but it's just really nice. Yeah, the uptrend line. And that is exactly the same level I gave you on the day we exited there. If you look, those are the same reaction points. So I just tried to point out for those not familiar with the futures, the price levels will change when the contracts roll. So it was close, but a few pennies off every time they futures roll. And so that's right now. I'm not looking to hit a home run again. I do have potential longer term upside targets that I may extend on this trade, but right now looking for that. That'd be a whatever it is. I'll pop up to that 427-ish level. Okay, so wheat, corn, soybeans are all sister trades. They're the three big grains. And you can trade, futures. There's ETFs for each of them as well. A lot of the agricultural commodity ETFs were retired by the issuers that had them in the last couple of years. We used to have ETFs for coffee and cotton, and there was one called JJG that had corn, wheat, soybeans combined. Those all three, the grains tend to move together, but anyway, you have to trade them individually now. And this is wheat, and it reminds me a lot of natural gas. I'm still longer term bullish. I've been bullish, longer term bullish since 2024, just like natural gas, and just like natural gas, it kept making marginal new but still divergent lows. This is big positive divergence building. I know what's going on now. I know that Trump trying to make Russia and Ukraine hold hands and sing Kumbaya. They opened up the Black Sea for wheat exports and all that. Obviously, that put some near-term pressure, took wheat down back to its recent lows. But we've also, a lot like natural gas, where I was gaming the more active trading as we're basing there, getting in and exiting. We've done the same thing with wheat. Now, I've highlighted on the 60-minute chart these kind of more swing trader trades where you get these divergent lows and then breakouts right there. And these are all trades. We had T1 hit, T2 hit. These were targets laid out. They still maintain these targets, these longer term targets. And then after that, when you get these divergent highs, that usually sends you back down to the bottom or a slight undercut. But you look for these divergent lows. That was a divergent low. We rallied. And these are all double-digit gains. I believe they're all double-digit gains. And then that one didn't have a divergent high, but we just got sent back down. I just want to point out we now have, once again, a divergent low. And again, we're at long-term support on wheat. And in fact, let me pull a chart up for you. Hold on one sec. I have to cue it up. Okay, this is the long-term chart of wheat futures, a continuous contract. This is stockcharts.com. This is my long-term uptrend line. It looks like it drifted a little. I don't know why it did that. Let me fix that. Okay, keep in mind this is an EOD or end-of-day chart, so they update it every day. So that'll be through yesterday's close. And I've covered this many times in the past. This is a secular bull market uptrend line. Very well defined. Goes back to, this is literally in 2000. So we're looking at a multi-decade trend line, 25 years, quarter century. And it's well defined, and that's it. So we had that tag right there. And as I've been saying now for months, this is a longer term buy signal to come if and when this downtrend line gets taken out. And that should send wheat up for the next rally. And then wheat, once it starts to go, tends to go pretty full throttle. It often does these parabolic type advances. So either way, the thing is, it's not going anywhere. It's been trading down these multi-year. This is the last couple of year and a half or so at that level. But so there's minimal downside. Unfortunately, wheat doesn't pay a dividend. If you had a 6% dividend yield, it'd be great. We'd be getting paid. So it's one of those things. I wouldn't engage it aggressively yet. But when it breaks out, we start to get some buy signals. I think the upside potential. You can see my two targets right there, about a little between 750 and 800, up to about 950. And those are just near-term targets, and we're in an inflationary environment. Wouldn't surprise me to see these previous highs. Actually, that is the final current long-term target there. So either way, I don't want to spend too much time on it, but we still have the chart's still constructive. The divergence has been in place, been highlighted, just continues to grow, and we just made a recent low, and we just need to break out. And then the other ones, let me go to those real quick. I've talked about corn and soybeans doing better than wheat, looking better. This is a 60-minute chart. You can see we're at, let me tweak that trend line right there. Fix it up. We're right at trend line support. uptrend line support. This is what it looks like on the daily, same thing. And that's it. So we were long here. There was a breakout. That was resistance level. My first target was hit right there. These are targets, by the way, guys. I've been bullish, since 2024. We hit the first target there. We just hit it again there. That was T1. And these are still the additional targets. So if we hold this trend line support, basically you need to see a break above T1. If we break above T1, I think corn is going to let loose. Wheat tends to follow corn. It's what I call kind of a competing food source. You go to your favorite Mexican restaurant, you order the fajitas. They're going to ask you want corn or wheat tortillas. You go to the grocery store, you buy your cereal, you can buy corn. It can be corn or wheat. So they're very similar uses, and so when one gets too far ahead of the other will play a game of catch up. So far the corn is moving up, and it's at this uptrend line, but again, this is the big level here. I don't want to spend too much time on this. I just wanted to give an update because it's been a while. And then soybeans as well. We already hit my first target. Again, big divergent low. So these are long-term trade ideas. You can see the 200s there as well. So basically this is the trend line. T1 got hit. You have this downtrend line. If they pop the trend line, especially if they pop T1, then these are your longer term targets. So right now these guys are kind of sucking wind, but at support as well, you can see that's one little brief visit below that support level. I'm going to add that line right there for you right now. And that's it. So there's your update on the grains. Need to take those trend lines out. You can hone down to the 60-minute chart. I don't have anything really marked up right now. Let me add that trend line or the price support level I gave you right there. So ideally, soybeans will hold above that level. And again, this needs to break out each of these resistance levels and then go on to hit those longer term targets. Oh, quick update on OJ futures. Remember, this is that the really nice support level. We haven't gotten all the way there yet, about 227. But we do have, that's a weekly chart just showing you those two major reaction highs. Remember, we had a multi-year basing pattern, and then OJ futures just went insane, crazy with all the hurricanes in Florida that damage the crops, and then things that go near vertical or parabolic tend to crash. And so OJ futures are really setting up. If they get there, great. That'd be a great buy point. But that's a weekly chart. If I go down to the daily chart, as I pointed out recently, we have positive divergence. Let me zoom in here, and you can see here on the daily chart. So that's that same support level. We're very close to it. Positive divergence right there. You can see it even better on the 60, drop down to a 60 minute chart. And you can see some pretty big divergence forming here on OJ futures. Let me pull that down there and scrunch move that up like that. And so right here, this is your positive divergence at the recent lows. And again, a little more downside possibly, or not. Sometimes they can come in and buy it. You have a trend line like that. If we can pop that level, OJ futures look good for a nice counter trend trade. And KC coffee futures still look very toppy to me. If they take out this trend line, they may want to put in a margin move and still divergent high. However, again, based on various time frames, I think that might be the end of the run for coffee. I've been short this one, shared it for you as a short trade idea. It's right, I think there. I think that was our initial entry there because it had gone parabolic as well, along with cocoa and things like that went parabolic last year. And that's it. So we broke this primary trend line. We were back testing for a while, just broke that. This is, I think, the lights out level under about 370 should be lights out. Take coffee down to these next targets I gave you there. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great